Hey there, it's Mike Langford. Welcome to the Augmented Advisor Podcast, brought to you by Blue Leaf. This week on the show, John Prendergast and I are joined by Dave Hinnenkamp, CEO of BerganKDV, a comprehensive business, financial, and technology solutions provider that does a little bit of everything to help your business with what it needs most. And if you swing by BerganKDV.com/about and watch their Do More video, not only will you learn a little bit more about what they actually do, you'll get your money's worth in entertainment as well, I promise. So definitely check that out. We asked Dave to join us because of his unique perspective on the proposed changes to the federal capital gains tax rate and how it might affect your clients and the climate for mergers and acquisitions for RIAs and independent financial advisors. You are in for a treat with this episode. We cover a ton of really, really interesting and frankly, nerdy stuff. Gotta love it, I promise. Before we get started, please take a moment to subscribe to the podcast on Apple Podcasts, Spotify, Google, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a topic or a guest for the show, please feel free to reach out. You can hit us up on blueleaf.com or find us on the socials. We're active on LinkedIn, Twitter, and basically everywhere. Blue Leaf's easy to find. John's easy to find. I'm easy to find at Mike Langford. Pretty simple, basically everywhere. That's where you'll find us, okay? We'd love to hear from you. Okay, let's get to the conversation with Dave Hinnenkamp. Dave Hinnenkamp, John Prendergast. So great to see you, gents, on the Augmented Advisor Podcast. Welcome to the show.
Thank you. Great to be here. Second one, and really enjoyed the first one, and I've got even higher standards for this one.
Well, that's because John's here, right? Like, I set the bar low, so then I bring in the big guns. John's on this pod, and it's going to be phenomenal.
That sounds
fantastic.
Right.
I walk over the bar, you paint on the floor, right, Mike?
I like that. I'm going to use that. That's really, really good. Well, John, building on that podcast, and we'll throw some homage to the team over at Skyview Partners. We had you on because on that podcast to talk about capital gains tax, particularly as it relates to financial advisors who are looking to buy or sell a business and how that might affect that type of stuff. And we wanted to build upon some of the topics we talked about over on that show here because the audience for the Augmented Advisor is not just advisors who are thinking of buying or selling a business, right? These are operators. These are people who are growing and managing an existing business. And we want to talk about some of those topics here. And we may touch on selling a business or whatever. Because I'm sure there's some crossover from one audience to the other, from one show to the other. But we have a very distinct and large following for Blue Leaf and their client base, and also the advisors that they reach. So maybe we can kick things off with actually talking about what are these proposed capital gains tax rate changes and why should we care?
Yeah, and I can certainly weigh in on that part. When you think about the capital gains rates, they've been relatively steady for a lot of years, and then you've probably heard recently that President Biden has suggested that the rate be higher for those that need to pay their fair share. And I say that tongue in cheek because I haven't quite figured out what exactly fair share is yet, and I don't think anyone does. So right now, what he has proposed, and it's his proposal at this point, is that if you, quote, make over $1 million, your capital gains rate goes from what is now 20% to 39.6%. And depending upon your tax bracket, there's also a 3.8% kicker on top of that called a Medicare tax or net investment income tax. So effectively, the 39.6 becomes 43.4. And that's just the federal rate. So whatever your state rate is, that's tacked on top of that. And they have clarified a little bit, or at least some of the literature has clarified what he means by make over $1 million. And some of it that I've read has actually been a little more alarming in that the new rate would apply to anyone that made over $1 million of adjusted gross income. Even if it was $1 above, all of the gain would be taxed at that higher rate. Again, this is something that is talked about and proposed. I find it hard to believe that it would get through the final legislation in that matter. And as I've spoken before, I find it hard to believe that 39.6% is going to be the rate that ultimately comes out at the end of this. But that is what is proposed at this point in time, and we'll see where it comes out. And I'm sure there will be some battles as it goes through the House and the Senate.
Yeah, I'd imagine so. Nobody likes to see their tax rates double. I'm going out on a limb here, and
I think it's a safe limb. You can venture out on that one fairly far, I think.
As somebody who has to, write a big check to Uncle Urs every year, I would like to see that number go up two-factor, I'm sure, for anything. Why is this a potentially big deal for financial advisors specifically? I mean, how might this increase in capital gains tax affect them? I guess it's safe to assume that many advisors are thinking about this more in line with their clients, right? The client portfolio impact, right? We're all aware of capital gains tax rates and how it affects the client portfolios. But from an advisor's perspective, what are you seeing?
I think the part that's alarming to me about the proposed hike in capital gains rate as it is proposed today is it doesn't differentiate between capital gains that are a result of portfolio income. So I'm an investor, I buy a stock, it goes up in value, I hold it more than a year, I pay long-term capital gains rates. Makes sense to me. So they're having a conversation about, hey, it's the wealthy, quote, that have those capital gains. What I believe it misses in the whole thing is there's a difference in my mind between the passive investor that buys a stock as it goes up, go up and has a capital gain, versus someone who's worked their entire life in a business and now they just happen to be ready to sell at the point in time where capital gains rates go up. I don't believe that is the intent of the legislation, but certainly they would be captured by it. And this is a point in time, if someone's ready to sell, it's because they've made a conscious decision that they're at a point in their life where they want to get out of the business for whatever reason, spend more time with family, health reasons, you name it. And unfortunately, now they're in a situation where they have to either be forced to A, make a quick decision to sell before the rates go up, or B, potentially pay a higher rate. Some of what I've heard recently is that there was some talk about the increased rate being retroactive, which in my mind would be really damaging because that would be inconsistent with a lot of other things that have been done. So we'll have to wait and see. But that is the most alarming part about the cap gains rate hike, is it doesn't differentiate between capital gains related to portfolio income and capital gains related to a business that someone owns. And I think there's a difference.
John, you've kind of got two hats a little bit here. You are a business owner, so I'm sure you're thinking about this a little bit here. But and you serve the advisory community, and I'm sure you're thinking a lot about this. And then of course you've got your background from investment banking, so you're
Don't hold that against me, Mike.
What's going on in your mind as you think about this, these potential changes here and how it might affect the ecosystem?
I think Dave's right on what he said, and in particular to start out with, I think we've got to recognize that this is an opening gambit in terms of the proposed legislation, and it's not likely to wind up in this form. And I do think the cartoon outlines of this proposal leave a lot of problems, like Dave described, right? Not treating passive versus active capital gains differently. And I suspect that depending on what goes forward, that much of that would get worked out. That would be my best guess. In fact, I think there was an article I saw in CNN talking about Biden officials, suggesting that there's a bunch of the current tax code that they could leave alone in order to create a bipartisan deal. And if they're really serious about a bipartisan deal, then they're going to have to address the concerns that Dave just raised, right? That said, you know, I think as a business owner, working, for decades in many cases, to build value with the expectation that you could harvest that value in a reasonable way, and the fair share you expected to pay was sort of your typical long-term capital gains rates, and for those to be doubled, it's a pretty harsh penalty. I do think that there are likely remaining alternatives that can still work under this proposal. Business owners who don't make $1 million a year, but who sell a business for a large dollar figure. That Dave, I think that's unclear how they would treat that, right? Let's say it's a $25 million sale, that could still be treated as or standard capital gains rates, right?
Possible. It depends upon how they define it, and is the gain part included as part of the "do you make $1 million" question, right? And that's the frustrating part about tricky. Opening salvos. Yeah, exactly. So that remains to be seen.
And also along those lines is one of my favorite little bits of the tax code is something we talked about in our prep call, the qualified small business stock gain exclusion. I haven't read anything where folks have talked at this level of detail about how this would interact with that. The little I've heard, discussed suggests that this might stay intact. Dave, have you heard anything? What are your thoughts on that?
Yeah, I haven't heard anything specifically as to whether this would be impacted by it, but I believe that would still be a good and valid election, and would potentially then not be impacted, obviously, in the same way as the other capital gains. So the challenge with it, of course, is to try to figure out exactly what the final legislation is going to be. So, and that's the frustrating part about advising business owners, in that you can have a discussion about it, you can discuss the what ifs, yet it's hard to prepare. And especially, as I mentioned, if they make this retroactive, it becomes even more difficult, because now all of the talk that you had is for naught, because it's the date within which to make a decision has already passed. So that to me is the most challenging part of it.
And Dave, for the audience who may not know about the small business stock gain exclusion, could you give a sort of brief Reader's Digest version of what that is?
Yeah, and here, Mike, I'm gonna have to give a little shout here, in that I'm not as well versed on it as I probably should be, frankly. The qualified small business stock, the way I understand it, and I'm going back to the old rules when I was in the practice side of it, is if you have a qualified small business and you file the proper elections, okay, then you can exclude gain as it relates to the sale of that. So that's my understanding of the way it is.
And I think the exclusion's up to 10 million, and in some cases can be higher depending on some of the factors. Is that right?
I believe that's right, and that was the piece, John, where I was thinking back and I was remembering the old rules, and it is up to 10 million, which is actually going to exclude then a lot of the advisors. So the key is making sure that the election was filed, and I don't remember the code section offhand, but that's not even relevant as long as you've made the election filed as a qualified small business. But that is a key piece. So it really depends upon how your business is set up.
And this is a perfect reason why you want to actually talk with a tax advisor as a business owner or as a financial advisor, to just understand the broad strokes so that you can spot that and advise your clients to get with their tax advisor when there are these issues on the table.
100%.
Yeah, when you talk specifically about that one election, that's one piece of it. It's managing the income while you have or own the business. And it's also making sure that your business is set up in the proper way. And if it's not, if you're not a qualified small business or you haven't made that proper election, then of course you have the rules that potentially you have to pay attention to now to make sure that you make the right decisions in order to get the best tax result that you can.
This is really awesome. And you set up my segue here, John, for getting to the fact that many of these advisors, that are listening here have small business owners or large business owners as their clients, right? I mean, it's if you think about building a wealth management business, chances are you're out there talking to business owners because usually that's how they accumulated wealth, right? Is they built it through a business or some other asset class that would appreciate and have the potential to create capital gain. So this seems like a great opportunity for advisors to incorporate tax planning into their business and specifically this moment in time, right? If I was an advisor and I had, 10 of my best clients own businesses, I'd be reaching out about this topic to have a nice, good conversation with them. What do you recommend that conversation start with, Dave? What do you think if you had to approach, 20 business owners as clients? What would be kind of the opening salvo here?
Yeah, the way I think of it, Mike, is let's take a look at the traditional accounting firm and let's take a look at the traditional advisory firm, and keeping in mind their areas of expertise. So accounting firms have a lot of their business is what is called B2B. So it's a business dealing with another business, and they're great having conversations about how to plan the business, how to manage the business, and how that fits into the individual income tax side. When you look at a lot of advisory firms in the wealth side, a lot of times the clients that they are working with maybe already had their liquidation event, meaning they sold their business and they have cash, and now you're helping them manage their wealth and their personal taxes. I call that B2C. So it's the business helping the individual, right? So the key is how do you connect all of the dots there? And I think it's extremely important that when you are advising a business owner, that not only do you consider what their current investment portfolio might look like, because there are different business owners. Some do have a lot of outside investments. Others put a lot of the money they earn back into the business, and their major investment is their business. So they may not have a liquid portfolio of cash to invest, or not a large one. But it's extremely important to make the connection between the business owner, the tax side of it, and maybe not if they don't have a lot of the liquid assets now, but they will in the future. So how do you plan for that? So you got to be able to have the conversation about not only where you are now, but where you want to go. So that having that broad perspective is extremely important. And I know when I could speak to BerganKDV when I started the wealth side, that was one of the differentiators that we had, is we wanted to make sure that we integrated investment planning with tax planning, financial planning, estate planning, and ultimately risk management. You don't have to have all of that in-house, but I think you have to be well-versed on it so that you can have the conversation and then communicate with the respective advisors so that the team collectively is aware of what's going on. So when you're working with a business owner, you have to make sure that if you're an advisor on the wealth side, that you think beyond the portfolio. And likewise, if you're on the CPA side of it and you're giving advice, you have to think beyond the business and think about what do you ultimately want this to do for you from a wealth perspective, and how do you plan now for that future event? And I think that gets missed quite a bit.
Well, and it's so important to appreciate, if you are a financial advisor, that a big piece of if they are an existing business owner, your client, that a big piece of their portfolio is that business. There's a lot of their wealth is tied up in that. It generates the income that funds some of the other investments that they're making. And so that needs to be considered, right? And so the value of that asset can be affected by tax rates, right? And making sure that they're getting proper tax advice. John and I had a conversation on a previous podcast with Jeff Brown, who is the CEO of NAPFA, the National Association of Personal Financial Advisors. And we talked about this, about advisors starting to offer other services that are related to your financial life that aren't necessarily just portfolio management, what we consider traditional financial planning things like which credit card to choose, maybe making advice and guidance on mortgage, the best mortgage for your refinancing needs or whatever. But this feels like something that should absolutely be in any advisor's wheelhouse of like, hey, we're bringing in some tax pros here to help you out.
I can think of one to me, what is a very vivid example of how this comes into play. And I think back to the economic downturn of 2008, 2009. And if you remember back then, well, many businesses, quite frankly, were struggling. There was obviously a financial crisis, and it affected a lot of businesses. It especially affected home builders and anyone in the construction industry. And we had a number of contractors that worked in that arena that had an entity that was a flow-through entity, whether it was an LLC or a partnership or an S-corp. But in any event, they had losses, and it flowed through to their personal tax return. And they had basis in those losses, meaning they could actually deduct them. They weren't suspended. Might be getting a little deep into the weeds there, Mike.
That's okay.
But
I like the weeds.
Here's
That's
what
great.
happens. Yeah. So here's what happens. So you drive your income negative or to zero. And what you're really doing is you're wasting those low tax brackets. As you know, tax brackets are graduated. So in my mind, you never want to waste the lowest tax bracket. So in that event, because we could coordinate with we could bring together the investment management and the tax planning, what we actually did is we said, hey, here's an opportunity. You have a $300,000 flow-through loss or $150,000 flow-through loss. You take your pick or whatever it was. How about we do a Roth conversion and we take some of your IRA and we convert it to a Roth? We pick up that income, but it offsets the loss. So we have, we are able to manage the tax bracket. And now what we've done is we've converted something that will be taxable in the future at whatever rate it is when you pull it out. We've converted it not only into a vehicle that will have a zero tax rate, but we also converted what would be equities that were at a very low level. So all of the appreciation took place in the Roth. And now not only is the income that you put into it not taxable in the future, none of the growth is either. To me, those are the types of things. If you do that one time, in my mind, you've earned your advisory fees for about 10 years.
I love it.
So those are key things that are outside of the normal arena of what you would think about in terms of managing a portfolio. But those are some of the things that provide real value. And it's all about not how much you make, but how much you keep. And that involves managing tax brackets over time. So you got to think about not only the tax bracket you were in last year or this year, but you got to think about next year and the years after that as well.
And Dave, this sounds like a concept you mentioned when we were talking before. I think you called it normalizing income, which neither Mike nor I had ever heard of. Can you talk a little bit more about that broader concept and sort of how you think about applying it, and maybe tie that into the work of advisors like you just did?
Oh, absolutely. So oftentimes on the advisory side, if you've got clients, when they come to you, and this has been our experience anyway, a lot of the clients are age 50 plus, and they're in or near retirement. So one of the reasons they're coming to you is because they're thinking about retirement. They've got assets out there and they want to know, hey, can I retire? Do I have enough money to get to the end of my runway, so to speak? And they want some advice. So that's a perfect time. So when I talk about normalizing income, what you have to understand as an advisor is, okay, when I stop working, when I retire, my earned income goes away, right? So that drastically changes the tax bracket that I'm going to be in. So the standard advice that we hear coming out of advisors quite a bit is, well, hey, harvest your losses. Well, do you want to do that? Let's take a scenario where someone retires and they've got IRAs, they've got their 401k, they've got other assets, and maybe they have a portfolio and it spins off a little income, but not a whole lot. And now they aren't collecting Social Security yet, and they've got a lot of cash, so they don't need to take anything out of their IRA. So they really aren't generating a whole lot of taxable income, and they might have very near zero taxable income. Because think about what generates taxable income. Well, if you're a retiree, now I'm talking about people that perhaps portfolio income is their primary source. They aren't taking any IRA money out, so nothing taxable there. They aren't collecting Social Security yet, nothing taxable there. And they're largely living off of cash that they have that is earning next to zero interest right now. So what do they have for taxable income? Not much. So the first thing to think about is, do most people realize that the capital gains rate, there is a 0% capital gains rate, and that exists at certain income brackets, and I believe it's up to $40,000 for a single and $80,000 married. So if your adjusted gross income or taxable income is below that, your capital gains rate is zero. So I wouldn't be harvesting losses in those situations. I'd be harvesting gains. And that's the type of advice that we want to give. So we have to be careful about handing out advice that is, call it cookie cutter advice, because it might work well for one, but it doesn't for the next. And then as you think about going into retirement, it gets very complex, because when you start Social Security is either 0% taxable or up to 85% of it is taxable. And that depends upon the income bracket you're in. Okay, so you can manage that income bracket. And the other thing is, and you may be aware of this, once you get to the point of Medicare, your Medicare premiums are different depending upon the amount of income you make. So if your adjusted gross income, if it's 88, if it's less than 88,000 for a single individual, less than 176,000 for a married filing joint, your Medicare premium is $148.50. If it gets above 500 married, or excuse me, single, and 750 married, it's over $500. All right, so you got to think about, in other words, you don't want your tax bracket to be at the lowest or zero one year, and next year you're in the highest bracket because, hey, I needed to buy a car, I needed to go on a trip, so you pull all this money out of your IRA in that year that you need it. No. You have to think ahead about, what is the average bracket that I'm going to be in over time based upon the wealth that I have, and then try to manage that each year. And I think that's the important piece, and that's where advisors can bring a lot of value by connecting with the tax advisor as well.
No,
I rambled
I like
on quite
it.
a bit there. Does that make some sense?
Go, John.
I'm processing it.
Yeah,
it's actually fantastic, right? To think about the long arc of your income, and therefore your income tax bracket, and thinking about optimizing when you take a gain or a loss based on that trajectory. And as you said, as you get closer to retirement, that starts to become more and more and more stable and manageable, right? So it becomes easier potentially to match those things up. So it sounds like a good thing for an advisor to be thinking about is, when somebody's starting to think about retirement planning, maybe even 5 or 10 years ahead, you can start to think about this concept where you really have some control over when you take what. And
right.
It's a phenomenal concept.
And I think the biggest opportunity for planning actually starts from the time you retire until you start collecting Social Security, and until you start needing to take money out of your IRA through required minimum distributions, because that affords you the opportunity to make sure that you can do what you want to do in those early years to make sure you utilize the lower brackets. And that's in order to know what the lower brackets are, you have to be able to project what they're going to be in the future. So those are years where, as I mentioned, you can take in those 0% capital gains or lower rates. Also, Roth conversions. So you can, even if you don't need the money out of your IRA, that's okay. Convert it to a Roth. Take the taxable income in at a lower rate and then let the growth take place at a 0% rate, and you never pay tax on it when you pull it out. So there's great opportunities from the time you retire until, and even beyond that, but specifically from the time you retire until you start taking Social Security or having to take or wanting to take money out of your IRA. Just great planning opportunities.
What I love about this conversation here is the significance and in many cases, the immediacy of the realization of the value of this advice and guidance that you could be providing to a client, right? Where a lot of times you're talking about investment management and you're talking, thinking about planning for the future and like how much is this investment going to grow to based on what we know, and there's a lot of future casting there, and moving things a little, from an asset allocation perspective, just a little bit here and there might produce 1 or 2% average annual return, right? That's awesome. And over 20, 30 years, that adds up to big dollars. But we're talking about the ability to potentially put an extra $50,000 in your pocket this year sometimes, right? Like this is significant, or 5,000, depending on the size. This is real significant money, and that adds up over time, especially if you're putting it back to work, as you mentioned, in a Roth or whatever. So to me, I totally nerd out on this stuff, even though I'm not a tax professional. Don't even play one on TV or the podcast, but I do like to hear about it. I like the fact that there's people who are like so much smarter and about this stuff than me. Like I can nerd out on this stuff all day. Let's talk about how advisors can work with a tax professional, because most financial advisors are not tax professionals like me. However, most are aware, as some of the stuff we're talking about, right, that there is value here in tax planning and tax strategies. So how does an advisor who might not yet be working with a tax pro in conjunction with their clients, how do they go about doing that, about kind of maybe finding the right one to work with and making sure that their clients are taking advantage of that advice?
Yeah, it's a great question. I think about it from a couple of different perspectives. The first thing is you have to know a little bit so that you aren't going to reach out to ask a question or get advice about things you don't know. So you need to have a little bit of background there. And actually, I think the industry might be changing a little bit too. There are many firms now that are starting to bring advisors or tax advisors on board. So I think that will evolve over time. The important thing to me would be, hey, build a relationship with that tax advisor. I think in the past, and I'm speculating a little bit on this, Mike and John. I think in the past, sometimes I sense that advisors at times felt threatened by the CPA, thinking that, hey, the CPA might give them advice to hey, why are you paying this person to manage your investments, or question the value that the advisor brings. And well, first of all, if they did, that would be really, really poor advice. Because I think wealth advisors bring a lot of value. And the second part of it is I think sometimes they might feel a little uncomfortable, like, hey, I'm in over my head on this. How do I go about asking those questions? But for me, I think it's that vulnerable piece, right? Where you're going to get, if you're vulnerable with your CPA and say, you know what, I really need your help here because I think there are more things that we could be doing for this client, but I may not be aware what they are, but I want to be here to let you know what I know, because the client probably told me being the advisor, probably told me some things that he or she didn't tell the CPA, and is probably telling the CPA some things that he or she isn't telling the advisor. So it's so incredibly important to get the two to communicate. And the question would be, well, why does that happen? Well, sometimes the client doesn't think one needs to know a certain piece of information because, hey, they're managing my investments. Why would they be concerned about what I plan to do with what I plan to do with this asset when I retire, if I want to gift it to someone. Well, all of this comes into play. And I don't think the client always understands that. So both the advisor and the CPA, frankly, should be pushing that client to make sure that their team of experts collaborate. I think it's extremely important, and I don't think it happens.
Dave,
enough.
it sounds like the first step in collaborating is simply asking your client, "Who's your tax professional?" and just getting aligned to them to start the conversation.
Absolutely. I think what happens is once you do that, and the tax professional and the wealth advisor start having conversations, quickly they realize that collectively they've got more information on that particular client than they had before. And I'm not talking about sharing information that's privileged information that you can't share. I'm just talking about, well, first of all, you would talk to your client and say, hey, are you okay with me having a conversation with the advisor, or are you okay with me having a conversation with the CPA? All of them are going to say, well, absolutely, that will only benefit me. So now you're open to have that conversation. And you're right, John, it's as simple as that. It's taking the time to have the conversation and communicating, and then being vulnerable, not only the advisor, but the CPA being vulnerable about not knowing the other one's business that well. And hey, I'm going to trust you to do well what you do, and I want you to do the same with me, and let's build that mutual respect. I think that's incredible.
I think that's an amazing piece of advice that I hadn't thought of being willing to acknowledge to another professional that you might not know some stuff. And some of the people that I would say some of the people that I know that I admire the most are really good at that. To be honest with you, they're very good at coming to you and just asking questions. You're like, you're worth like $100 million. You're asking me these types of questions. Like, oh, that's kind of interesting. You have a curious mind, though. You're willing to just admit you don't know anything about this.
That's why they're worth $100 million, right? They're not trying to figure out, hey, how am I going to get this done? They're trying to figure out, hey, who's going to do this, funny. Right? It's a different approach. It is true, though. And I, having been on both the CPA side of it and the wealth advisor side of it, I understand those vulnerabilities, because as a CPA, we're trained to be right. The expectation is that we get it right. And when you have to venture into waters where you don't know if you have it right, it's one of the reasons CPAs will tread slowly in those areas, because it's been part of their training that, hey, your job is to make sure that the end product is right. And same on the advisory side, it's they're going to get questions from their clients. Hey, the market went up this percent, and you were this minus 1%. Can you tell me why I'm paying you again? And I think this puts another arrow in your quiver, so to speak, because you can look at it and say, hey, you know what? That's important. But let's talk about a holistic relationship here as to I can add more value than this, and there's only a part of this that I can control, and one of them is not the market. So how do I provide the most value to you? And as you know, John, there are some great tools out there that can help on the investment side, right? So the part that those tools can always do is thinking and planning specifically on a prospective basis.
Absolutely. That's one of the many reasons why the robo invasion that was projected never really happened, right? It's just another service, because it turns out you need humans in the loop to really service other humans.
When you have a complex question, it's really frustrating.
Exactly.
When you go to a website and you're clicking forever and it's not there, right? It's like the ability to pick up a phone, shoot an email, whatever your preferred communication methodology is, and ask like, hey, here's the deal. Thinking about selling the business, moving the family from here to there, maybe because my son wants to go to state school in that state, and I'd rather not spend $35,000 a year on that state school. Can we make that happen? Right?
Yeah, there's so many more things that an advisor can add, and it's all about, again, having conversation, knowing your client, and knowing other professionals that can help out in the relationship, because the ultimate goal should be getting a great outcome for your client, and use whatever resources you need to do that, from technology and platforms to your own knowledge and expertise to your colleagues' knowledge and expertise to outside expertise. If you always focus from a client-centric mindset, you're going to get a great result for your client. And the client doesn't care who delivers it to them. They just want a great result. And if you can lead that, even if you don't do it all yourself, you're going to be the go-to person. You're going to be the first call.
You just like gave the pitch for the augmented advisor. You basically just encapsulated it in a few sentences. That's perfect. Like, augment your ability with other technology and other professionals, and your client will love you for it because you're bringing the value. They think of you as the person who delivered. That's wonderful, wonderful advice. I think it's a great way to kind of end the show and wrap this up. Before we let you go, though, we're going to start incorporating this question more frequently to wrap things up. We have a big community here at the Augmented Advisor podcast, and by extension, Blue Leaf. Lots of people are listening and or watching. If you could ask anything of that community, what would you ask of them?
Yeah, well, a couple of things. I think you touched on one of them, and that is certainly talent. We are always looking for talent, and it's not just talent in our local market either. With technology now, and somewhat in the new world that we operate with the virtual employee, virtual teammate, as we refer to call them. Any opportunities to find great talent that you think would fit into what we just talked about, because we do the advising, we have the CPA side of it, on the tax side of it, and we're always looking for people to add to our talented team. And then, yeah, obviously from the client perspective as well, if you have clients that have complex type situations and need some help in those areas, we can be a resource for you, because having dealt with a lot of businesses, a lot of individuals for many, many years, and knowing the importance of looking at the entire life cycle of an individual. And I'm not talking about their life literally now, but I'm talking about the life cycle of getting started in business to retiring to having a happy and successful retirement. I think that's extremely important. And oftentimes we only deal with segments of that, or the professions only deal with segments of it. So if you've got someone that has a complex situation that you think, hey, I could really use some help here, those are perfect. Thanks for asking that.
Yeah, well, thank you for coming on the show. It's been wonderful to have you. We'll make sure we send people your way. We will link up to your contact information, LinkedIn, and the BerganKDV website on the show notes, of course. So thank you very much, Dave, for joining us today.
Take care, Dave.
Thank you. Enjoy it very much.
Thank you very much for listening to this episode of the Augmented Advisor podcast. It was fantastic to have you with us. I hope you enjoyed the conversation as much as we did. Huge thanks to Dave Hinnenkamp of BerganKDV as well for joining us. Understanding how capital gains taxes affect your clients beyond their portfolios is crucial to helping them successfully navigate their financial lives. And of course, it's important for you and your business as well. Dave shared some fantastic stuff in this episode. As I mentioned at the top of the show, please do make sure you subscribe to the podcast on your favorite podcast platform, and do us a favor. Make sure you give the Blue Leaf page a follow on LinkedIn. We share every episode of the show on LinkedIn, and we would love to have you be a part of our community, okay? All right, that's it for today. Please make sure you're staying safe and be nice to each other. We'll see you next week on the Augmented Advisor podcast. See ya. Bye.